Okay, so welcome back to another section in chapter 11, which is dealing with depreciation. If you guys remember yesterday, we went over what depreciation was and how we use depreciation to measure basically the usage of our fixed assets, right? We have to find some way to represent that we're spending it in a sense where, we are intentionally devaluing the assets. But once again, with accounting, it's kind of confusing because in an aspect, right, we can't actually change the value of an asset, right? We can't just devalue something just because, right? There are standard procedures that you have to do, and depreciation is one of them, right? So yesterday we talked about all the things that there is for depreciation, and we also even learned the first method of depreciation, which is going to be units of production. So now we're diving into part 2, which is going to be looking at another one, which is called double declining, also known as the accelerated depreciation method. Okay. So once again, we are still going to be needing the same 5 key components, right? We do need to have the cost of the asset, right, which is everything it takes to get the asset ready for service, okay? And then we have the estimated useful life, or the expected use for production. So in this case, right, we are going to be focusing on the estimated useful life. So in this case, if it says this machine is only good for 5 years, then that's where we have to go off of. And remember, when we determine years, right, we're determining it just like our children, right? They have birth dates, so this is the same idea here. We also are going to be needing to know if there's a salvage value or not. And of course, the date that you place into service is also very important, because we will be learning a new key feature in this one, which is partial years. Okay? And last but not least, you need to know what depreciation method you're using. So in this case, we're going to eliminate that 5th one, because we're going to be dealing with double declining this entire section right here. Okay? So once again, what are the different types of depreciation methods? Again, we're going to be focusing on the accelerated, also known as the double declining, which in this scenario, right? How do we understand what double declining is, and how do we make it relatable to why we should depreciate our assets this way? Okay. And the number one reason is that the reason why you would double decline something, or in this case, right, we would depreciate it twice as much, is because the assumption is that when we have a fixed asset, most likely this type of fixed asset is something that we frequently use more frequently in its beginning of its years, but as time progresses, you use it less and less and less. So a good example would be a computer, right? Especially if you're going to school, right? You get the computer for the first time. You use it a whole bunch in the very, very beginning of the year. But as you graduate, then that computer slowly just ends up just sitting there on your table, and you'll touch it here and there every once in a while. So that's a great example, right? Where you're frequently using the computer in the very, very, very beginning of its life, but then when you reach towards its end of its life, you barely touch it. And that's very, very common, especially when we have electronics, right? Cell phones is also a good one, right? Anything that's like a cash register, right? You'll frequently use it more so in its beginning of its life, but as the computer begins to slow down, right, you kind of get tired of turning it on because it takes so long to load. So so that's the same idea here, where you're using it's in the beginning of its life, you're using it more often and more frequent versus towards the end of its life. Okay. So with that being said, what are the things that you will need? Well, in this case, right, the formulas are going to be similar slash a little different. Now, in this case, the only thing that's actually the same is going to be calculating the accumulated depreciation and also calculating the book value. However, when we look at the depreciation basis, the first three that we look at are going to be very different than the previous one that we just learned, which is units of production. So in this case, the depreciation basis is definitely different between the units of production and double declining. Instead of taking your asset cost minus its salvage value, this time we're focusing on the beginning of the year's book value. Okay, so in this case, because we're constantly calculating the book value at the end of a year, therefore it becomes the beginning of the year. Okay, so that's the same idea here where you're taking the total cost, right, and determining the book value of it, and that's what's going to be your depreciation basis. Okay, so we're focusing on primarily value. All right. So that's the first formula. The second formula we have here is where you're going to actually, the formula is 1 over its estimated useful life. So in this estimated useful life times 2, because 1, we're taking 1 as a whole number. We're taking 1 as an overall number, right? And then we're going to divide it amongst its estimated useful life. So in a sense, right, you can think of it this way, where you take the asset cost, right, and what you're doing is you're dividing it amongst its life. Okay, but at this time it's being multiplied by 2. That means, because like we've mentioned before, accelerated means that you're going to depreciate it twice as fast. So in this case, we have 1 divided by the estimated useful life times 2. So in this sense, right, if an asset lasts for 5 years, right, and we're progressing it at 2 times the level, you could say that it will not last all 5 years. In fact, it may last a little less, because you're decreasing the value, or you're depreciating it twice as much every year. Okay, so in this case, that's the difference there. And then, of course, when we solve for depreciation expense, it's actually going to be your depreciation basis times your rate. Where opposed to units of production, it was the number of units you produced that year times the rate. In this case, no. You're switching it up, and you're making this formula be available for the depreciation basis and the rate. Since the depreciation basis is going to always change, right? Since it's going to always change, it's going to also produce a different depreciation expense. And of course, we talked about accumulated depreciation and book value. Those are all going to stay the same. Okay. So let's go ahead and take a look at our first example here, where we are looking at an asset, right? So we're going to record the depreciation for the first year. So here we have a machine that is worth $15,000 with a salvage value of $2,500. Its estimated useful life is 5 years. The number of units that it can produce is 10,000 units, and the date that you place into service is as of January 1st. So in this case, we have our key components, right? In this case, we don't need to focus on the number of units that it can produce. We need to focus on the estimated useful life. So in this case, right, let's go ahead and solve each of the equations, starting with the very first one, which is depreciation basis. In this case, right, it's going to be my depreciation basis is going to be the beginning of the year's book value. So in this case, right, if you're starting on year 1, Your book value will be the fair market value that you purchase your fixed asset at. So in this case, my very first number, since I don't have a calculated number for my book value, right? I'm safe to assume for the first year, my depreciation basis is going to start out with $15,000, right, for the machine. Now, once we solve for that, we need to solve for our depreciation rate. And in this case, right, our depreciation rate is going to be 1 over the estimated useful life. So in this case, right, we know that 1 is there, but the estimated useful life we know to be 5, right? So in this case, it's exactly what you're going to be doing. You're going to take 1 divided by 5, right? And then you're going to multiply it by 2. So that's going to give you 40% or 0.40. There. Whoa. Okay. Press the enter button like 4 times. It didn't work. Okay. So then now that we have our depreciation basis and we have our depreciation rate, now the next thing we got to do is solve for our depreciation expense. So in this case, right, it's basis times rate. So you're going to take your 15,000 and you're going to divide it, or in this case, yeah, you're going to divide it, or in this case, multiply it by 40%, which is 0.04. Or in other words, you could just divide the whole thing by 20%. Okay? Now, again, that's not what I want to do because I don't want to confuse or do any extra calculation. So what I'm going to do here is I'm going to take my rate, convert it in terms of decimals. So we have 0.04, and then I'm going to multiply it by my depreciation basis, which is going to tell me that, hey, 40% or 0.4% of 15,000 is going to be $6,000. Okay, so in this case, that's what my depreciation expense is for the month of September. Okay, in this case, right, we're working in terms of December, or in this case, December. Yes, in the month of December, not September, because we're looking in terms of a full year. So that means in one whole year of using the asset's life, we've already accumulated $6,000 worth of depreciation expense. Okay. And of course, right, we know that because it's the beginning or it's the first year of depreciation, our assumption is that it should be 0 there is no previous one because it's 0 plus the current year's depreciation expense, which gives me 6,000. And of course, we got to solve for book value, which is the 15,000 divided by or subtract the 6,000 to get you a total of 9,000 left over. So this is where, so at the end of the year, my book value is going to be $9,000 because we took the 15 minus the accumulated depreciation to get us a total of 9,000. So therefore, right, if you actually really calculate it down to its boil, that is almost half the asset, right? That's 40%. That's close to 50%. So in this case, right, that's what it means to decrease or to depreciate it twice as much, all right? Because right here, this is almost half the asset, right? You used it for half, in this case, for the first year, you used it for almost half the cost of the asset, okay? So now let's solve for the second year. So if at the end of December 1st, December 31st of the first year, right? If we know that we calculated the book value to be 9,000, then our automatic assumption is that for the year number 2, we're going to use that because the beginning of year 2, which is January 1st, compared to the end of December 31st, right? It would equal the same. So in this case, our number one thing that we know here is that means our depreciation basis for year number 2 is going to become So the book value for year 1 is going to become the depreciation basis for year 2. All right, so now we have a basis to start with, which is $9,000, which is, again, beginning of the year's book value. In this case, this is the same thing as your end of the year's book value of $9,000. And then this is where you're going to start calculating everything else, okay? Once again, do that per unit rate of 40%. In this case, depreciation rate is 1 over its estimated useful life of 5, which is 0.2 times 2 gives you 40%. So here, right, I plug in all my numbers, right? I figured this out that 9,000 times 40% is going to give you 36,000 this time. And again, your depreciation expense is going to be those two numbers added up together to give you a grand total book value of 5,400. And again, for my book value ending in year 2 is 5,400, then that means that's going to be the depreciation basis for the 3rd year, because it's the beginning of the year's book value, and so on and so forth, okay? You need to keep calculating until you reach either 1, the end of the estimated useful life, or 2, you, when you depreciate assets like this, at the end of it, it may reach the end of its life, so it may extend for 5 years. Sometimes it might not even make it to 5 years. So in this case, you're gonna just keep working until you reach the end. So here, once we reach the 4th year, notice this. We've calculated the amount to the point where now my book value is reached 1944. Now in this case, if we remember our rule of thumb here, your book value cannot fall below salvage value. In this case, how much is your salvage value? The salvage value was $2,500, right? So in this case, right, we need to stop here and we need to revert or undo this transaction, because once again, we can't have our book value to be calculated lower than salvage value. So in this case, we're going to actually cross that out, and what's going to happen is you're going to bring the book value up to the total amount that it should be, which is $2,500. Okay? $2,500. And once you reach there, then you're going to actually start working backwards, because in this case, you have all the information you need to be able to solve for this bracket, or this table, right? You have everything you need to solve for it. So again, how do you solve for it? Well, in this case, right, we are going to know, what we do know is that we have the salvage value at 2,500, right? But if we take the formulas that we've been using in order to be able to solve for it, right? How do you solve for the accumulated depreciation? Well, isn't the accumulated depreciation normally the accumulated depreciation, isn't it normally where you're making a payment? The accumulated depreciation, the formula for accumulated depreciation is, well, in this case, what I'm looking for book value, right? How do you determine the accumulated depreciation? Well, the formula for book value is going to be your asset cost minus accumulated depreciation. So if that's the case, you're going to have to work backwards to the point where you're going to be solving for this. So right here, the accumulated depreciation is going to be, if you take the book value, right, we know what book value is, and we know what the asset cost is. So in this case, we're taking the formula to solve for book value, and we're converting it so then we're able to understand it and be able to solve for the rest of the table. In this case, right, we know for a fact that it's 2,500 for salvage value, and what you're going to do is you're going to undo it. Okay, you're going to undo it, or in this case, when you're trying to solve for the rest of the things, you're going to kind of work backwards. So in this case, right? The formula for the book value is, once again, your asset cost minus accumulated depreciation. And just like order of operations, right? If you're able, if or in this case, math, right? If A plus B equals C, well, C also equals A plus B, and then also A also equals C minus B. That's the same idea here, where you do need to move around. So in this case, the formula to solve for the accumulated depreciation is going to be the cost of the asset minus the book value, which in this case, right, we take our 15,000, we're going to subtract the 2,500 to get a total of the 12,500. So that's my accumulated depreciation. Once again, we're going to work one more time backwards once again, because in this case, right, we needed to reflect how much depreciation is going to, that needs to be calculated in order to reach the total amount of the 12,500, right? So in this case, right, if you use the regular math, you use regular math to solve for this particular equation, you're going to figure out that depreciation expense is actually going to be your accumulated depreciation. Hold on, let me try to do, okay, so to solve for accumulated depreciation, it would be the previous year's accumulated depreciation plus the current year. So in this case, to solve for the expense, it's going to be your previous minus your current accumulated depreciation, which right here, again, I take my current accumulated and minus my previous, which gives me a total of $740. So that's going to be your depreciation expense for the end of the 4th year. But hold up. It barely reached 5 years. So in this case, the idea here is that it's because the fact that we're using double declining, we're depreciating it twice as fast. So therefore, we are getting rid of it a lot quicker because we're using it extensively, right? The more you use a machine and equipment, any type of stuff to make products, the more you frequently use it, the more likely it's going to break down a lot faster and a lot quicker. And that's the same idea here. Okay. Any questions in regards to solving for this table?
Not a question, but it's similar to yesterday how we took the current value and then subtracted from the other column the depreciation. Yesterday, similar to that.
In context of what? Like,
For I guess just like the equation part of it. Down at
um,
the bottom, the depreciation expense.
yes and no. So again, remember, there's slight differences in regards to this, right? There's very minor changes, right? Instead of starting off with an asset cost minus salvage value, you're starting off with your beginning of the year book value. So in context, like overall context, yes, you are finding some kind of way to represent that you're trying to spend or use this machine. So at the end of the day, you are trying to get rid of this machine or use it. But the way that you calculate it is essentially the difference.
Oh, okay.
Mm-hmm.
Thank you.
Mm-hmm. So yes. So once again, it had a capacity, or it had a life. Excuse me, not capacity. It had a life of 5 years, but because you keep using it so often and so frequent in the beginning of the years, it didn't even make it to its 5th year. All right, and that's true, right? You drive a car, you drive it down to the ground in the very beginning of its life. Of course, it's going to break down a lot quicker and a lot faster, and you need to probably maintenance it a lot more often. So that's the idea here for the depreciation for double declining. Any other questions?
No.
Okay. So notice this, right? I was talking about that you cannot rely on the number of years that it can last because it's subjective, right? Depending on how quick and how often you use this, right? It doesn't determine, the life doesn't determine how long it will last. Okay, so it could be less than 4 years, it could be more than 5 years. Okay, it could even reach up to 8 or 7 years, 7 or 8 years, but it will, the determining of the estimated useful life isn't going to determine whether it will reach its end of 5 years or not. Okay, so that's definitely something you need to make a note here. What you do notice is that, again, the your depreciation basis is always going to change because due to you solving for your book value at the end of each year. And you're going to notice that the rate stays the same, but once again, it's multiplied by 2, right? It's 1 divided by the estimated useful life times 2. You're depreciating it twice as much. And once again, the depreciation expense is depreciation basis times rate. So once again, once you reach the end of its life, or just reach the end of its of its production, right, at the end of its year, at the end of its life, whether it reaches the full 5 years or not, at the end of it, you need to make sure that your book value equals salvage value. Okay. So once again, we're going to talk about how you're going to use this information to go ahead and journalize this transaction. Now, in this case, right, the journal will look identical. Okay, the only difference that you have here is the way that you calculate it. So in this case, you're still going to have your depreciation expense and your accumulated depreciation, but this time, right, we're going to take a look in context of what we solved in our table, which in this case, right, we solved for the depreciation expense to be $6,000. So that's exactly what you're going to put here, okay? And that is just how you're going to journalize it. Everything else will look the same. So depreciation expense and the accumulated depreciation is all going to be associated with one another. Okay. So again, second year is going to be the same thing, right? Depreciation expense and accumulated depreciation. And notices that because when we solve for the table, right, and we're decreasing the value differently, right, because it depends on what the basis is. Okay, you're gonna notice that every time you journalize this, it does look different every time because it's a different number that you're using every single time. Okay. Okay. So then the next step, the next thing I'm going to show you is called partial years. Now, we've already taken a look at this example before. However, in this context, this one actually applies because in this context, right, when we're making assumptions or we're just making up rules, right, we need to follow them along the way. So in this case, this example here where we bought a $10,000 machine and its salvage value is $2,500, just like before, right? Giving you a total of $7,500 to be able to depreciate. Again, and you have to figure out what the date that you placed the service, because that is the most important thing that's going to determine whether you need to count the whole year or you need to count a part of the year. Okay, so the number one thing that we have here is going to be that we're recognizing that we bought a machine for $10,000. Salvage value is $2,500. And the useful life is 5 years. And the date that you place it into service is October 14. Okay? Since that is one of the components that we need to keep aware of or be aware of, especially when we're dealing with double declining and straight line, Okay, so with the assumption that you do your adjustments at the end of every year, right? If you placed it into service as of October 14, when did you actually place into service and when are you actually going to start depreciating it?
In October.
In October, because in this case, right? In the scenario, it tells us that we put it into service as of October 14. Now, October's the month. Now, let's determine which month are we going to depreciate it. In this case, it was on the 14th, which is definitely more than 50% of the month. So therefore, I need to start as of October. And if this adjustment is done at the end of the year, then my assets, I'm going to depreciate it for October, November, and December. How old is my asset then?
3 months.
It is only 3 months old. So let's put this in context, okay? If I have an asset that's only 3 months old, then how much can I actually depreciate it for the first year? So let's solve for each one. So the depreciation basis, again, is going to be beginning of the year's book value, which is 10,000. Rate is going to be 1 over 5 because it's 5 years times 2, which is 40%. So that's going to give me a total of $4,000, right? 1,000 times 40% gives you $4,000. Now hold up. This is for a total of 1 whole year. In this case, this is where you have to be very careful because is your asset a whole year old right now?
No.
It's only 3 months. So in this case, 4,000 is not going to be your correct answer because this is determining what the value is for the whole entire year. But you can't depreciate an asset for a whole entire year. It's only 3 months old. That's not fair. You're wasting or you're calculating, 9 months of, valuable production usage of the asset when it's only 3 months old. So this is where we're actually going to be doing this. Now there's a couple ways that you can figure this number out. Okay, so in this case, right, since we know that 4,000 isn't our correct answer, we know that it is going to be used for 3 months, right? We're going to depreciate it for 3 months. 3 out of 12, which is also known as 0.25%, or also known as 1/4 or 25%. Okay, whichever way that you want to see it. Okay, at the end of the day, you are depreciating it for a quarter of a year. Now, in context, right? If I'm doing it a quarter of the year, I need to recalculate what my total amount of depreciation expense is. So there's again another way that you could solve for it, which is taking the 4,000 and multiplying it by the 3 out of 12, which should give you a total of $1,000. Okay. Is everyone okay here? Where we cannot write it off for the full year because that's not how old the asset is. The asset's only 3 months. You shouldn't be able to do that because then you're wasting the life of the machine. You're recording it over than what it actually really is. So in this case, we need to figure out how much are we actually depreciating it for the first year, and then so on and so forth, and then be able to solve it by solving for the full years and then adjusting it accordingly to fit that actual criteria for the first year. So in this case, 1,000, right? 4,000 times 3 divided by 12, okay? Or you could take 4,000 divided by 4, which gives you 1,000, okay? And that is it right there, okay? So that's it for this one. Okay. Now, of course, with that, how do you journalize it? Same thing, straightforward. You're going to treat it exactly the same. Nothing's different when it comes to journalizing it because all you're recognizing is depreciation expense and accumulated depreciation. And again, for the first year, since you only place it in service for so long, it's only accumulated a total of $1,000 dollars worth of expenses. Okay, so in this case, $1,000 is going to be in the debit and in the credit. Okay. Any questions in regards to chapter 11.2?
No.
Okay. So here, right, the chapter 11, you don't need a review on that, right, because it gives you like all the components. So here I gave you a cheat sheet for the formulas right here. Now, for any reason that your book value does fall under salvage value, here are the steps you need to take in order to solve it and make it so then it does equal salvage value, okay? And once again, double declining is based off of using the product a little more often in the beginning of its life versus towards the end of its life. And again, another reminder, book value must be equal to salvage value at all times. Cannot fall below or cannot be under, okay? So let's go ahead and take a quick couple minutes to go ahead and go over the example we have here. Okay, so question number 1. Okay, so here's the 11.2 depreciation double declining method exercises. Ooh, what a mouthful. Okay, so question number 1 says that you purchased a cash register for $300, okay, with no salvage value, okay. Its useful life is 5 years, and it can print up to 5,000 receipts, okay. And then, of course, you put this cash register in service as of January 8th, okay. So the assumption here is that we are focusing on years. So at the end of the year is when we actually start computing our expenses, okay? So again, what was the asset that I purchased? We bought a cash register. How much was the cash register?
$300.
$300. What was the salvage value?
0.
No salvage value. What's the estimated useful life of this machine?
5 years.
5 years. And what was the date that we placed into service?
January 8th.
January 8th. So what does that tell us? Are we going to depreciate for the month of January or the month of February? January. So if our assumption is that we adjust at the end of the year of December 31st, therefore we are going to be depreciating it for its whole entire year in the very first year. Okay. So let's go ahead and dive right into this right here. So what is going to be my depreciation basis?
The 300 that we bought it for.
Good. It's going to be for 300. Okay. What is going to be my rate?
$40.
What was that?
40%.
40%. Okay, so good. It's going to equal 1 divided by 5. Okay. Times 2 to give you 40%. Okay. So how do I solve for my depreciation expense?
$120.
120. Okay. So then, of course, our assumption here is that because it's our very first one, that is what my accumulated depreciation is. So how do I solve for my book value?
180.
180, right? It's going to be my original asset cost, right? This is the same right here, minus my accumulated depreciation to give me a total of $180. Okay, good. So then, how do I solve for my depreciation basis for year 2?
$180.
Right, because if we solve for the ending value of the book value at the end of year 1, that becomes the beginning of the year for year 2. So in this case, we're going to take my 180 that is solved for the book value at the end of year 1, and that's going to become my depreciation basis. Okay, good. What's going to be my rate for year 2?
The same.
It's going to be the same. So if that's the case, it's going to be the same for all 5 years. Okay. So in this case, if that was true, then how do I solve for my depreciation expense for year 2?
We multiply the 180 by the 0.40
Mm-hmm. And
to
what
give us 72.
to give us 72. So what is going to be my new accumulated depreciation? Because now we actually have a beginning balance or a previous balance.
$192.
192, right? So therefore, what should be my book value at the end of year 2?
Equals 180 minus
Not 180 minus,
the 192 minus the 180.
no. It's the asset cost.
Oh, okay.
Mm-hmm.
300.
108.
No, wait. Okay. I see.
Mm-hmm. Remember, it's asset cost, not book value minus the accumulated. That's how you solve for the book value is the asset cost minus accumulated depreciation. Right? So in this case, 108 is going to be our number. All right. So then if 108 is going to be our book value at the end of year 2, then that becomes my book value for the beginning of year 3. Okay. So then what is my depreciation basis for year 3? I'm sorry, depreciation expense for year 3.
$43.20.
$43.20. Okay, so that should give you a total accumulated depreciation of
$235.20.
$235.20. Okay, so then what is my book value now for the year 3?
I got 64.80.
64.80. Good. Which then becomes my depreciation basis for year 4. So in this case, year 4, all right, what's my depreciation expense?
$25.92.
Good. Which brings my accumulated depreciation to?
$261.12.
Good. Which brings my book value to be for year 5?
$38.88.
$38.88. Good. So once again, that becomes my book value or my depreciation basis for year 5. So what's my depreciation expense?
$15.55.
$15.55, bringing your accumulated depreciation to?
$276.67.
Good. Bringing my book value to be?
$23.33.
$23.33. So here is where, in case, so this is what you also need to know too. Whenever you have a salvage value of 0, you're just going to keep dividing it over and over and over and over. It will eventually reach to the very last penny, but that's not going to be for quite some time. Now, again, if you have the estimated useful life of 5 years, right? Sometimes when you reach the end of its life, it only can last, it's valued at $23.33. Of course, you could keep on going. There's no rules against that because you haven't reached your salvage value. And it's a cash register, right? It should still be able to function beyond its estimated useful life. But in this case, depending on how frequently you use it, what if you accidentally broke one of the buttons on there? So then, therefore, you can't really technically use it. You have to fix that button. What if the scroll tape on the receipt, one of the wheels popped off? You can't really run it, right? There's a lot of things that you can't do once it reaches its end of its life. Okay? In most cases, when you have a salvage value of 0, you could keep calculating on and on and on, and you will never reach 0 until, like, keep on going on forward until you're down to your last penny. In this case, right, when it comes down to that, you are safe to just dispose the asset at $23.33. Again, you keep using it for another year if you'd like, or until as long as it takes to get rid of it. But in this case, right, you might be better off buying a brand new cash register because, again, especially with technology, it's been 5 years. It's most likely an old school cash register, right? Like it's got buttons where, now it's digital, right? Everything's digital touch screen now, right? So then again, therefore, again, to do the technology, right? You might be better off just buying something new than continuously using what you already have. And it's already reached its end of its life. And it's right now valued at $23. Who's going to buy a 5-year-old cash register from you for $25? Yes. I bet you someone's just going to be like, you know what? I'd rather buy something brand spanking new. All right? So that's the idea here. So you can stop here to write it off at when you're completely done or dispose the asset properly. Okay? So question number 2 says, in this case, we need to record the adjustment entry for the first year. So in this case, the first year, how much did I actually depreciate? $120. So how am I going to journalize this? So 12/31 is the assumption, right? At the end of the year. How am I going to journalize my journal?
So you have depreciation expense and accumulation depreciation, no?
Good, yes. So you got depreciation expense and you have the accumulated. So I'm going to put accum for short. Depreciation, right? For your $120. Okay. And of course, I even ask you for question number 3, go ahead and record the adjustment for entry for year 2. So in this case, what was the second year? How much depreciation did you actually? What was the depreciation expense that you had for year 2?
$72.
$72. So again, your journal will look the same, except the numbers are going to look a little different. So you have another thing right there, except this time it's for $72. Right? So far, so good?
Yes.
All right. So let's get a little more complicated. So question number 4 says, well, in this case, you decided to purchase a computer for $1988. Okay, so $1,988. Okay, which includes all fees and taxes, which with shipping and all that stuff, right? Includes all the fees, with a salvage value of $200. Okay. And its useful life is 5 years. Okay, and you put this computer into service as of August 25th. Assume that the adjustments entries are made at the end of the year. Okay, so again, the asset that we bought is a computer. Okay, how much was this computer for?
1988.
1988. Okay, and what was the salvage value? So now we actually have a salvage value. And what is it?
$200.
$200. Okay. What is its useful life? 5 years. Right. And what was the date that we placed it into service?
August 25th.
So what does this tell us?
That we're gonna depreciate for September, starting September.
Good. We're going to depreciate it starting in September. Okay. Okay. So let's go ahead and plug our information in for depreciation basis. So what would our depreciation basis for the first year of this computer be?
1988.
1988. So in this case, what is going to be my rate? What's my rate going to be?
40%.
40%. Good, because it's going to be 1 divided by 5. okay? Times 2, right? And just by knowing this key feature, right, we know that this rate is going to stay the same all 5 years, okay? So then, in this case, what is going to be my depreciation expense?
I find 265.707.
So I'm going to use equal round here, just in case there are some numbers that could cause us to have big numbers. So in this case, what did you get?
So, but it is 4 months, no all year. 795 divided by 12 and time 4, no?
Good, correct.
265.
Good. You just recognized that well. Well, the first year, this is for the whole entire year. I'm not going to depreciate it for a whole year because I put it into service as of August 25th. I don't start depreciating until September. So September, October, November, December. That's 4 months that I used for this asset. So in this case, I do need to put in here that I'm going to, again, multiply by 4 and divide this by 12 because that's how many months I used it for, right? September, October, November, December. Only 4 months out of 12 months to give me a total of 265.07. So good. All right. Because we have the idea that this right here, the beginning of its life, right? We only used 4 months. Okay? So therefore, what is going to be my book value?
1722.93.
1792.93, which becomes my book value for year 2. Or I'm sorry, which becomes my depreciation basis for year 2. Okay? All right. So this time, because now we've already used the first 4 months, now we're starting from January all the way down to December. So how much is it going to cost me for a whole entire year to depreciate?
Oh, 689.172.
Mm-hmm. 0.17. Good. So then, what is going to be my accumulated depreciation?
$954.24.
Good. So therefore, what should be my ending, what should be my book value at the end of year 2?
768.69.
768. Okay, you probably took the 17.
Oh, yeah. Equals 1722.93.
No. Remember, to solve for book value, it's the asset cost.
Oh,
Mm-hmm.
1988. Okay, 1033.76.
Okay, good. Within now, again, that becomes the book value for year 3. It becomes the depreciation basis for year 3. Okay, so let's go ahead and keep calculating. So in this case, right, what is going to be my depreciation expense for year 3?
137.83. No, I keep getting that wrong. 413.50.
Okay, good. So then that makes my accumulated depreciation to be,
5523.
wait, what was that?
I five 413.23. I don't know. Well, that's a mistake. I don't know.
Okay, so remember it's 1033.76 times 0.4. You should get very close. It should be like 49.
No, I find 08. That's my mistake. I don't know why.
Okay.
Oh, it's 900. Oh, that is my mistake. 954.92. That's what I have. I don't know.
Okay.
Doesn't matter.
Okay. All right. So again, if we solve for accumulated depreciation, right, we're going to add the 954.24 with the 413.50 to give you a total of 1367.74. So then, therefore, what should be my book value now for year 3?
I got 620.26.
Good. 620.26, which once again becomes my depreciation basis for year 4. Okay. So once again, how do I solve for my depreciation expense for year 4?
We multiply 620.26 times the 0.40.
Mm-hmm.
I got 248.10.
Perfect. 248.10. Right? Then we're going to add this numbers together for our accumulated depreciation.
1615.84.
1615.84. Good. Bringing my book value to be
372.16.
372.16. Now, we're getting closer to the salvage value of 200, right? So let's keep on going because it says that we can keep on going because we haven't reached salvage value yet. So, what's my depreciation expense for year 5?
148.86.
148.86?
Yes.
Perfect. And so therefore that brings my accumulated depreciation to be,
1764.70.
which brings my book value to be
223.30.
223.30. Right? So in this case, right? It's been 5 years, right? Now, I haven't reached salvage value yet. Can I still keep going?
Yes.
Yes, you can. But here's also a factor here. How old is my asset?
5 years now.
Is it really 5 years?
Oh no, because we started late in August, so 4 years and 3 months.
4 years and 4 months old. So in this case, I can for sure 100% go for a year 6. Okay, because my asset is only 4.5 years old, or roughly 4.5. Okay, so therefore I can carry this number over. Now again, the rate's going to stay the same. So again, for year 6, it's also going to stay the same for 40%. So in this case, what is going to be my depreciation expense for the 6th year?
89.32.
89.32, bring in my total accumulated depreciation to be
1854.02.
Good. Which,
It cannot, one second, it cannot be 89. There is not a full year. It's 9 months. I don't remember how many months we took it out.
okay, so if you recognize it that way, if you're trying to make it exactly 5
Oh, I don't know.
years,
Yeah. I don't know if you're gonna do for a full year or you're gonna do for the time that you. I
okay?
don't know. I don't know. I just follow the exercise. I don't know what we're supposed to do.
Okay, well, in this case, right, when we talk about time sensitive, does it matter how old my asset is? So in the first example, right, or in the example we did in the PowerPoint, did it reach its 5 years?
No,
So at this point, does it matter how old my asset is?
no,
Not really, because in this case, right, we're not thinking about how old it is, we're thinking about reaching its salvage value. But let's put into context, okay? Let's do what you said, right? You said that there's no way that you should depreciate it for $89.32 because that's for the whole year. So let's put it in context, right? If I've already depreciated 4 months, so I have how many more months left? 8?
yes.
Okay.
Mm-hmm.
So in that context, okay, so here it is. All right. So I have 8 months left out of 12. So in this case, I can only depreciate it for $59.55. Now, okay, since I'm self-referencing, it changed all my information here. Look at my salvage value, or look at my book value. Is it above or below salvage value?
Below.
It's below. So even though we depreciate it for 8 months of its life, it's still below salvage value. So at the end of the day, we need to still make adjustments here because we can't accept this amount. So I'm going to go ahead and undo that because that was just the example I was showing you guys, okay? Oops. Okay, so $89.32 is the original. Now in this case, I can't use this number. So what I'm going to do is I'm going to go ahead and cross strike them out because I can't use those numbers. All right? I think it's this one. And I'm going to choose strike through. Okay? So this is where I have to start working backwards. Okay? So in this case, right? What's my book value supposed to be? What is my book value supposed to be at the end of the 6th year?
200.
It needs to be 200. Right? So in this case, right, if you remember the whole A plus B is equal to C concept, right, the formula for book value, okay, so let me make some extra space here. Right, the formula for book value, right, is equal to your asset cost minus accumulated depreciation. Okay? Which in this case, right, we know what our book value is. Our book value is $200, right? And we know what our asset cost is, which is the 1988, right? And what we need to solve for is the accumulated depreciation, which is the previous number here. So within this context, right, if we need to solve for what does 1988 minus A gives us 200, and how do we solve for that? Okay, so what is 1988 minus 200?
1788.
1788, okay? Now we need to work backwards one more time because now the formula to solve for the accum, right, related depreciation, is equal to the previous year's accum minus the current year's depreciation expense. Okay, so in this case, right, we know that we have 1788 equaling what is our previous accumulated. In this case, it was 1764.70. All right. Oh wait, I think it's plus current depreciation expense. Okay. So how do we solve for this? It's supposed to be previous. Previous accumulated depreciation plus current depreciation expense. So in this case, right, I need to solve for whatever amount is going to give me this number. So in this case, we need to subtract 1788 minus the 1764.70, and what do we get?
2330.
2330. And that's the number you need to use to override this to make sure that at the end of the day, your total accumulated or your total book value ends up being salvage value. Okay? Now, that's one way of doing it, right? Is solving it backwards. But if this also is another shortcut, if you kind of figured it out before, if you notice this, my book value right now is 223.30. My salvage value is 200. So if I just knew I need to just subtract the 200 from my book value, all I need to depreciate now is $23.30, and you can walk forward or calculate it going forward. All right. Sometimes some people see that quicker, but in this case, because I'm teaching it this way, because that's not always going to be the case. Right? You may not get this very simple, easy number to figure it out. You may have to work backwards to solve for this number. And in this case, that's how you work backwards to solve for this number right here. Okay? All right. Any questions in regards to what happens when you your book value falls below salvage value?
So the question from before. So except the first year, all the time that you do depreciation, you're doing for the full year, no?
For the first one, no. In this one, no, because it's
No,
not.
Just for the first one, no. The rest, yes.
Yes.
Doesn't matter what.
Yes.
Mm-hmm. Just,
Mhm.
to know.
All right. So the last two questions is going to be doing the adjustment entry for the first and second years. So if you guys remember, it's going to be the same journal entries, except the numbers are going to be different. Okay. So I'm going to go ahead and save some time by copying and pasting this information in right here. So what was my depreciation expense for the first year?
$265.07.
26507. 26507. Okay. Okay, 26507. What was the depreciation expense for the second year?
$689.17.
689.17. Okay. And that is it for chapter 11.2. Any questions at all in anything that we just did today?
Oh, did you say that 200, if you subtract 223.3 minus 200, not always is going to be the like that? Not always is,
In
you
in
have
in
to work.
in this case, right? It's just
To work.
it will work this scenario, But
Mhm.
again, when you're looking at another scenario, which you may go for a seventh or an eighth or even a ninth year,
Mhm.
then no, you won't be able to solve it right like that. But in this case, right, by me noticing that with this one time that I calculated my depreciation expense for the 6th year, I end up going over by a lot, right? But in this
Mhm.
case, if I were to just solve it like that and be able to see, well, my right now my book value is currently $223.30, and my end goal is that if this on the 6th year I depreciated it, it dropped to be below salvage value, then how much do I need to get to 20 or to 200,
To
right?
200.
You could just simply take the $23.30 because that's exactly how much you're going to depreciate in order to get your book value to equal salvage value. Okay,
Mhm.
so that's only for this scenario. Okay, if you do
Yeah.
end up going to a 7th year, an 8th year, or a 9th year, then no, unfortunately, you wouldn't be able to solve it going forwards by doing that method.
Mhm. Okay. Okay. Thank you.
Mm-hmm.